Hey, all, welcome to Share Track. This is Raj here, and this is the second episode of our India focused investment related series. And our objective is to give you an idea of everything that you can find in India in terms of investment opportunities, investment tools, be it shares, commodities, options, mutual funds, ETFs, or business opportunities. So we're going to cover them all. And we already done our first episode. You can go to our homepage and you'll find that in our list of videos. Today's chapter is going to be focused on gold. We are going to start off with the most basic and traditional investment opportunities in each episode. And as we go further in subsequent episodes, we'll go into more complex investment opportunities like options. And we'll also be touching upon other complicated instruments. So for various levels of sophistication, you'll find something out here in this channel. With that said, I would like to invite my guest, Kumar Natarajan, who has got a lot of experience in this field. And he's going to walk us through gold today. So welcome, Kumar.
Thank you for inviting.
So Kumar, our topic today is about gold. And this video is focused purely on Indian investors or even for NRIs who are focused on investing their money in India in a more productive and balanced way. So what is your message regarding gold, and can you educate us about how we can use gold as part of our investment portfolio?
Yes, as usual, before starting anything, we are not personal financial advisors for you. So please consult your financial advisor before you take any investment decision. We are just sharing our opinion and our understanding and our knowledge of that particular asset class. To start with, gold has been a traditional storage of value. So in the previous currencies were gold backed. So you needed to have sufficient gold in order to issue a currency, which the US did away with and now freely prints notes. But then if you look at it, many of the central banks also regularly buy and store gold for their portion of assets for the country. So you will see that the gold prices keep moving at different levels, also primarily because of sovereign buying plus retail buying. And incidentally, India is the biggest retail market for gold. So that's where most of the retail purchase of gold happens. And India, traditionally, gold has been considered a precious metal, a holy metal, an auspicious metal. So there are festivals in which the suggested course of action is to buy gold, like Akshaya Tritiya. So Indians have been users of gold for a long time, and it's considered auspicious. So it's part of weddings, it's part of ceremonies. A child is born, you give something in gold, it's considered good. So gold has always been something which the Indians have been attracted to. Now, if you look at it as an asset class, it's part of the commodities. So you have several commodities like rice, wheat, and gold, silver. All of these form part of the commodities. So technically, you can buy and keep gold and invest in gold or trade in gold. You can do all three like any other commodity. So to start with, how can you invest in gold and how much should you invest in gold? Gold basically has an inverse relationship to both inflation as well as the stock market. So when the stock market goes up, the price of gold doesn't go up at the same pace. It may remain stagnant or even come down. But when the stock markets go down, the price of gold goes up. And you can check this out over the past 10 months. When the markets went down, the prices of gold went up. So that's one particular correlation for gold. So it provides a balance to your portfolio. So if your portfolio has shares in it and the shares go down, the value of gold goes up. So your portfolio gets balanced to an extent. So it's up to you as to how much you want to allocate to commodity and which commodities, and then look at it as to how much of that will go into gold. That is one part of it. Second part of gold for you to invest is, and this is especially for Indians, even if they are NRIs or they are resident Indians, gold is something which people give during weddings and it's in quantity. So it's not a small 1 or 2 grams. It's usually in a bigger quantity that gold is given in wedding to the child. So basically, the logic of that is, in case of hard times, you have a value adding asset which you can use as a collateral or as something which you can sell and generate some more capital for you to restart your economic activity in case you have gone into a downturn. So that's the kind of logic why gold has been consistently been given during weddings for the newlyweds, so that in their wedded life, if they have a problem, they can use that as a collateral. And if they don't have a need for it, they can pass it on to the next generation, who, if they have a problem, can again use it.
Yeah.
So this way, if you look at it, you may also invest in gold in order to give it to your offsprings. So in both cases, it doesn't make sense for you to just, think of it when you need it. You need to
Right.
plan for it because it's an asset which on a consistent basis is always on an increasing path because it's precious. It's got limited supplies and the cost of mining keeps on increasing. So the value of that commodity keeps on increasing. So and it's not perishable.
Right.
So you may see as a commodity, the wheat prices can go up and come down significantly uh, because it's perishable. After
Right.
point in time, it's gone. So this is not perishable. It's got ages to go before it can anything can happen to it. So looking at it, if we start with the first part, which is buying physical gold, people can buy physical gold very comfortably, and you can go to banks. There are banks which sell gold here in India. So you can go to a bank and say that I would like to buy gold, and they give you proper gold, coins, bullion, the way you want it. They will give it to you for the amount that you're giving it to them. There might be some level of service charges for the marking and all those things, but that's it. You can buy gold, or you can go to some of the reputed jewelers and buy from them hallmarked gold. They also sell coins and biscuits and other things in gold as physical commodity. And you can also, if you really have significant quantum of requirement, you can, and if you think that the price of gold is going to go up or anything, then you can buy it in a futures contract. So you think that over the next 6 months, because most of the future contracts are 3 to 6 months,
Right.
and globally in futures commodity contracts, you have to take delivery of the asset or you have to give delivery of the asset. So in that case, they are at a higher quantity because they are traded at lots and those lots are higher. So if you think you need that kind of a lot over a period of time or at a point in time and you have saved up for it, and you think that over the next 4 to 5 months, the price of gold is going to really go up, and if you would like to buy it today at today's prices, it would be great, then you can buy a futures contract today and take delivery of the gold when it expires.
Right.
So you have booked your price today, and that's a risk you're taking of the market moving in the direction you think it is. If the price of gold falls, then you would have
We,
paid higher amount. But
yeah, and we'll be covering these options and futures also in the subsequent episodes where
in
you can get even
subsequent
more reinforcements.
events. So these are the various ways of buying physical gold. Now, the good part about physical gold is it's in your possession, it's in your hands, so you
Right.
can keep it safe and all those things. The risk it carries is that of theft,
Yes.
robbery.
Yeah.
So you will have to spend in safekeeping of this gold. So you may have to rent a locker or something like that where you can keep this gold, because it is something which can expose you to being robbed. So, and that is a cost that you need to add to it. Number one. Number two, if you think buying jewelry is something that you would like to do, based on which you get gold and you also get jewelry which you get to use now, because bullions and biscuits you can't use, but then jewelry is something you can always use. It's not a bad idea, but the thing is that what happens is, if you buy a jewelry, there are different fashions, themes which keep on changing. So over a period of 4 to 5 years, you may like to change the jewelry design, then you give the jewelry back. They will, at those rates of gold at that point in time, they will take the gold and they will give you new jewelry as on that date. But here the cost that involves are two. Additional cost is making charges, because any jewelry that you make has a making charge. And on making charges, there will be tax. On gold, there will be tax. So these tax you pay, and you also invest in safekeeping of these because they are physical in nature. And that becomes an issue
So
for many people.
gold is taxed in India?
Yeah, there is a GST involved in
Oh,
buying and selling of gold. Plus making charges, there is a GST because
in
it's a service.
jewelry. In
In
jewelry,
jewelry,
not in bullion.
even in gold.
Oh, out here we don't have any taxes on gold and silver in Canada.
No, many
And
places it's not there. And there are also import duties in gold.
oh,
So if you're bringing gold from outside, you have to pay a customs duty first to bring it on par with the other gold imports. You're just allowed a limited amount of personal jewelry. Beyond that, it's all gold is taxable. So you have a customs duty that you have to pay before you get the gold into India.
right, right.
Okay. So if you look at it, these are the aspects of physical gold, how you can invest in physical gold. And ideally, if you're buying gold, buy hallmark gold because that certifies very clearly the quality of the gold you're buying. You have 22 carat, 24 carat, 18 carat, and the level of purity, all of that you get certified through hallmarking. And there's a cost for hallmarking which you have to pay. So these are all costs and risks of safekeeping, etc., that as we mentioned, that you need to incur in case you are interested in getting into physical
Physical,
gold.
physical gold.
And gold historically over the past, say 15, 20, 30 years has given an average annual return of around 14.38%. Gold as an asset class.
Impressive.
That's pretty good return
Yeah.
compared to any of the other asset classes. You can just to put it in perspective as to what kind of return
Yes.
you get on gold. Then in India, you have other ways of also investing in gold. You have ETFs available.
Right.
So you can just subscribe to those ETFs and they store the gold on your behalf. So if you invest X amount, they buy that much gold and keep it as the back end. Like if you're buying an index ETF, it allocates the index shares to those units that you have given in a fractional manner.
Right.
Similarly, gold ETFs also allocate fractional quantity of the gold to your account when you buy the ETF. And you can buy any quantity of ETF and you can sell any quantity of ETF along with it.
Right.
You can also uh, trade in those ETF on the markets. And ETFs basically are will have the risk that you have in trading in ETF, in trading in a capital market, because
Right.
there is not only the inherent back end of gold up and down movement, there is also the speculation aspect of whether it will go up or it will go down,
Right.
which gets factored into the price of the ETF because it is traded on a second to second basis during market hours.
Are there options on ETF in India?
Uh, the, some of them have, but majority of them, their ETFs are just categorized as mutual funds, and on mutual funds you don't
Okay.
have options.
Right. Okay.
So basically, when you look at an ETF, what it does, how does it help you? One, you don't have to store physical gold. You don't have to pay all the related cost of hallmarking and all those things.
Right.
And the third thing is you want to buy gold as an investment so that in future when you need gold, you can get that gold. So you target how much you want, how much of a gold you want. Say you say I want around 50 grams of gold to be accumulated for whatever reason as an asset class or to give it to my children or whatever it is in 10 years time. You keep investing some small amount every month in the ETF, gold ETF. So over a period of time, it accumulates to that quantity. And what you have done is you have averaged out your cost of buying over a period of time. So you will always get the gold when you
That's
want it and sell it. The amount that you get by selling the ETF will be on that day's gold prices very closely interlinked, marginally up or down based on the speculation aspect that you will be taking it. So
and
you
you
will
avoid
have
all the HST issues, GST
yes.
issues.
So you can get the liquidity to buy the gold as on that day's rates if you go through the ETF route. The cost aspect of ETF is one, you need to have a demat account. So for the entire period, you'll be paying demat charges because
Right.
ETF you hold it in demat accounts because it's a traded security. And the other thing is, as most of the ETFs or any fund for that matter, they have an expense ratio which they cut for managing the fund. So that is something which on an annual basis is taken from your fund. And in case of ETF, because it is a passive in nature, it's usually very less, but still there is a charge. So that's a cost that you're paying. And that too over the period of time that you're holding the ETF. And the trading cost, you need to have an account to trade the ETF and they will have charges for doing the trade, buying and selling and all of it. So though that's how you can get into gold with a gold ETF. There are a lot of gold ETFs available. There are also gold mutual funds available. So ETF is passive, mutual fund is active. So and mutual funds are not generally traded in the market.
Right.
They are either sold or purchased back by the AMC.
Right.
So there are also some mutual funds which track gold, but these mutual funds which track gold actually do not track the underlying gold. What they track are gold related companies.
Right.
So it could be a jeweler,
Miners.
it
Yeah.
could be a miner, or it could be somebody who's trading in gold, a bullion exchange for
Right.
that
Right.
matter.
Gold
So
sector.
they identify the sector related to the gold and trade in that.
Okay.
And the added risk for mutual fund is because it's trading in shares of companies involved in what you call gold related activities, the impact of market ups and downs are felt by the shares,
Right.
irrespective of their underlying linkages to gold.
Right.
So if there is a crash like it happened when COVID occurred, all shares fell, including the gold company shares fell.
Right.
The price of gold did not fall,
Right.
but the price of the shares of companies which deal in gold fell.
Yeah. You have to keep that in mind while investing.
So the market risks are very much there when you get into a mutual fund. But in
Right.
case of gold ETF, it is they purchase gold at the back end.
Okay.
Okay. Now the third way for you to look at gold is actually buying shares of the company which are involved directly with gold. So there are several well-known jewelers in India whose job is primarily dealing in gold. So they also buy a lot of gold, they sell a lot of gold, their jewelry value is linked to the price of gold. So their products are fully linked to the price of gold. Plus, they have a premium of revenue by way of making charges and others and how they make profit out of that underlying commodity.
Right.
So it's always a commodity price plus, which is how you will look at them. But then they have demand and supply because they can get new competitors and they can lose business if you're invested in one company. So this these are the few. And now there are a few emerging what you call before the emerging one, I would like to touch upon the one of the best instruments for investing in gold that is available today only in India and
Right.
primarily for Indians. Okay, what is it? The government issues something called sovereign gold bonds every year.
Right.
Every 6 months, you have those gold bonds issued. And if you're having any account with any of the banks in India, you will keep getting emails during that period that sovereign gold bond is being offered. So there are different series of it. And what it basically, the idea behind sovereign gold bond is to say that instead of people keeping physical gold, we will give them a guarantee of gold, saying that we will each of those bond, it's a government borrowing kind of a thing, wherein each of the bond is per gram based.
Right.
So the value of one bond is
Is
equal to
1 gram.
1 gram as on the date that they have fixed, which is something like 15 days from the date of issue. They take an average price of gold for the 15 days till the date of issue. And that is the price they fix it and say this is the price at which we are selling 1 gram of one bond, which is equal to 1 gram of gold.
Yeah.
So you need to buy in multiples of 1 gram. So you technically would be taking those bonds as number of grams of gold that you want to buy.
Right.
Okay. What is the benefit? The benefit is it is usually tenured for around 8 years. The tenor of the gold bond is 8 years. It can also be traded in the stock market by making an offer, and if somebody buys it, liquidity is limited, but you can still trade. That option is available. As a bond, it can be traded in the capital market. But there are a few benefits involved with sovereign gold bond. They not only give you the pricing, like on the maturity, the pricing of the gold bond is based on the maturity date, 15 days prior to it, the average price of gold,
Okay.
on the basis of which they will be redeeming your gold bonds. So the capital appreciation is dependent on gold purely.
Right.
So whatever the value of the bond at that point in time when it is due for redemption will be based on the price of gold. The other thing is they offer you a 2.5% interest per annum. on the value of the bonds you have purchased. So if you look at 8 years period, over 8 years period, you are getting that much additional interest which you don't get it in any product.
That's right. Yeah.
This is not available in any other product. And if you hold it for 5 years and you sell it after 5 years, either in the outside market or after 5 years, you can give it back to the government with a request for redemption, saying that
Okay.
can you redeem this bond, and or you can hold it till maturity. But after 5 years and till maturity, the capital gains are not taxable.
Oh, okay. It
So
gives incentive to wait until 8 years.
it gives incentive, but that is, you need to consider, even in case of physical gold, in case of ETF, they are all subject to the tax slabs as per the as applicable to those instruments. They are physical gold is also a commodity. So you bought something, you sold, you made a profit. As a commodity, it will be assessed, and you will have to pay the tax on that, because it will come as an income, and you will have to show how that income came. If you say you sold gold, then you have to show the price.
Yeah.
And if you show the price, the profit accordingly will be subject to capital gains tax.
Got it. Yeah.
So that doesn't apply for sovereign gold bond if you hold it for more than 5 years and redeem it with the government. If you sell it in the market through the capital market, it is subject to tax
Okay.
as a market instrument.
Got it.
Okay. Now, coming to a unique offering which is also coming up in the market, which I recently read about, is there are a few startups which are starting to look at gold leasing.
Oh, gold leasing. Okay.
Gold leasing, because what happens many a time is there are a lot of corporate companies and others who need gold, and they regularly trade in gold. The supply may be in short supply, so what they need is they need some avenues from which they can get gold, and they can give the gold also. They don't have to buy the gold. So a leasing opportunity exists, which these startup companies are looking at fulfilling. So you can put money with them equivalent to some amount, some quantum of gold, and they buy the gold for you, and they lease that gold to the needy people. And whatever revenues they generate, they give you a share of it.
Okay. Okay.
And at a point in time, if you want, you can get the gold back from them. So that's a new product which is coming up. And
I guess that will also be monitored by the RBI and SEBI and all those guys.
I haven't had much information about this. I've only heard about one company which is looking at this and doing it, but not much information came about it.
Okay.
So going down the road, because with the other example that I'll come to now, you will know that somebody starts and then somebody else, there are too many players who come in, then the regulation comes into place.
Yes.
So basically, the other aspect is for the past 15 years or something, there has been, which was not there well before, you have something like companies which focus on lending on the basis of gold as a collateral.
Right.
So I think Muthoot Finance was a company which started this long back from Kerala, because in the south of India there's a lot of gold available with families and retailers, retail investors, family heirlooms, whatever it is. So what they do is, you can take your gold to them, they verify the gold, they check the purity and all those things at their own without any cost, and they take the value of the gold as on the date you're taking a loan, and they will give you a loan which is roughly around even 70 to 80% of the value of the gold.
Right.
And that frees up cash for you to do something.
Got it. Yeah.
And you also get rid of the need to safeguard that gold, because it is being safeguarded by the company.
Right.
They have to keep it safe now. You don't have to.
Yeah.
You got the money for it. And when once you repay it, you can ask them to give back the gold. They will give it to you. They don't melt it or anything. It is in the same form that you have given.
Right. Right.
So the collateral used for the loan by them is primarily gold.
Right.
So this also helps a lot of businesses to start up. Somebody wants to put up a small shop or do some new business venture, and they don't have a capital, but they have gold in the family. They can go give the gold to these companies, take a loan, and at least invest the capital in a business that they want to do.
Got it.
And once they started, there are now several companies which have come up and which are giving these kind of facilities of lending against the metal. And then there is competition, so rates of interest and all those things. And here the interest rate on the borrowing on the loan given is also very minimal, because look at it from the point of view of how does this work. If you're going and keeping a deposit, or you're asking for a clean loan, in that case, the interest rate that is charged to you is a markup on the cost to them.
Right.
So for a bank, if they are giving a maximum of say 7 to 8% of interest for fixed deposits, and then you go and ask them for a loan, even against a fixed deposit or on a clean basis, for against a fixed deposit, they will say 3% above the deposit rate, so 10% we will give it to you. Or if it is a clean loan because there is no collateral, they will say we will charge you 12%. But in case of gold, the value of gold keeps on increasing, so the interest rate they are charging is very minimal, from 2 to 3%.
Right.
Which is basically the margin that you will be actually paying on top of that. So the rate looks bigger in case of normal borrowing. In
Right.
case of gold lending, the borrowing, the rate looks smaller.
Right.
So,
Yeah.
for example, you want to invest in a property and you want to take a loan, you can take a gold loan, pay part of the money for the property with that loan, and settle it in EMI basis, and take a property loan for the remainder.
Right. 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 Yeah.
So this frees up a lot of liquidity of the amount invested in the gold.
Got it. Got
We
it.
need to look at it like that, that it's an asset you have, which you can also get temporary liquidity from it. You don't have to sell it to get liquidity. You can
Right.
borrow against that asset.
Right.
That applies only to physical gold.
Right.
Normally, you also have borrowing against market instruments like ETF and other things, which again, if you have a gold ETF, you can still put it up for as a collateral and borrow.
Got it. Yeah.
Okay. So basically, these are the kind of avenues from where gold as an investment works out. And as we said at the start,
Yeah.
historically, or a very long period of time, the average annual CAGR for gold is around 14%,
That's pretty healthy. Yeah.
which is pretty good.
Yeah.
And it's a traditional method of building an asset.
Right.
And you also have countries which keep storage of gold on a regular basis. They monitor the level of gold, because in case the economy goes down and they have a problem, then this acts as a reservoir for them to generate more capital. Because if you buy it, if say a country has been buying gold for 50 years,
Right.
the average cost of that gold is very low for that country.
Right.
So after 50 years, if they have to go and borrow, or their credit worthiness goes for a toss and they have to then put up collateral in order to borrow, which happens to countries as well. In that case, this collateral works out much cheaper for them because they have already built it up.
Right. Right. Right.
So this was about gold.
Yeah. So yeah. So gold is a very interesting commodity, and just to summarize what you have said, Kumar, for the layperson, the overall message is that gold is one of the easiest way in which, and one of the most basic way in which people used to invest, and it still continues to be one of the most basic ways to invest. And the reason that you would like to invest in gold is because, first of all, gold has got limited quantities. Gold has got ceremonial value in India. It's got a lot of significance culturally in India. And it's also given as gift during weddings and when a child is born and all those. That's the cultural underpinning. And many people in India do this. So they need to have some gold for that purpose. So that's one aspect. But on the other hand, there are many new modern ways of investing in gold. One of them is the gold ETF. Because if you keep physical gold in your house, then you need to have security and other things, or you have to put it in a bank locker and pay locker fees and all those things. So, and also you'll have HST or GST on top of buying gold. The other option is to buy a gold ETF, where the ETF keeps a reserve of gold to back up the equities that it has sold you. And it also grows just like the price of the gold. And when you want to sell it, you can sell it in the open market and take back your money. So that's another avenue. Then there are gold mutual funds, which may not actually deal in gold, but they will deal with the gold vertical, in the sense they would have holdings of companies which are jewelers, they will have holding of gold mines, and so on. But one of the advantages of being in gold ETF is that it's purely holding only gold. Therefore, even if the market goes down, the value of gold remains. Whereas if you are going to a gold mutual fund, then when the market goes down, the gold mutual fund will also go down. And in case of an ETF, there is no leakage of money because everything is quoted in the share market, and the corpus of fund that the ETF had in the beginning remains regardless of how bad the market is. Whereas with a mutual fund, when the value goes down, there will be a lot of people trying to redeem their mutual fund, which will force the mutual fund to sell at a loss to pay back the money. So those are other things that you have to keep in mind, I suppose. And then we have the other opportunity in terms of using gold as a collateral. That's what you mentioned, Kumar, that at times of crisis, one could use gold as a collateral. And also in the past, during wars and a lot of displacement, people have left their belongings, but they were able to carry gold with them and go to another country and restart their lives. So gold in a way provides the security out there. So these are all the summary of what you said.
I would like to add one more thing. As you said,
Yes.
they took the gold with them outside. And
Yeah.
now, especially for non-resident Indians or people who are staying abroad who are going to come back to India and settle down in India,
Yeah.
they might have accumulated gold
Yes.
wherever they are. Thinking of all the requirements, it's the same for everybody. But when they're coming back, the point is if you bring that gold in the form that it is, you will be charged taxes because there is an import duty and other things which you will be
Yes.
have to pay. You will have
Yeah.
to declare it and then pay, and then the cost of your gold increases. So the ideal form is for you to sell the gold from wherever you are coming at
Right.
market prices, very close to the date of you traveling from there. Sell the gold there at market rate because it's going to track market price globally is more or less similar. So you sell the gold, encash the money, remit the money to your account in India, which is an NRE account. And once you are back here, you can invest in one of these instruments or buy physical gold, what you want to do, so that you avoid the cost.
Right.
Because when you're, say, changing residence from another country to India,
Right.
whatever money you have in your non-resident account is considered money remitted from abroad, which is your earnings abroad. They are not taxable in India for
So
that
that's a
reason.
very elegant way of moving your gold holdings from abroad to India when you're returning.
Correct.
Yeah.
Because India is concerned about the amount of physical gold supply coming into the country.
Right.
Because
Okay.
it can also be used for non-legitimate activities as a
Right.
means of payment.
Right.
So they have a limitation as to how the supply. That's why there is all those duties involved around it.
Got it. Got it. And I was also reading off late that India has increased its gold reserves. So one of the things I would like to tell the viewers is that there is an inverse relationship between the value of money and the value of gold. So as money's value goes less, which means when inflation comes in, the value of gold improves because the currency is weaker. So earlier, if you had to pay 100 rupees to get a piece of gold, now the same piece of gold you'll have to pay maybe 107 if inflation is at 7%. So those kind of dynamics also apply. So overall, gold is a much more traditional and safer beginner's investment, and you can do it with 1 grams and so on from a local jeweler as long as it's hallmarked. You have good value, and slowly you can build your asset and net worth.
Rightly
So
said.
so Kumar, so that was a very nice introduction to gold. And what is going to be our topic for the next episode? What are we tackling in the next episode for investment?
I think we'll start with the traditional what people have been investing. Our parents, our grandparents, they were
Yeah.
investing. So that's why we started with gold. So the
Yes.
next logical one would be fixed deposits
Fixed deposits. Okay.
because that's where people put their money
Right.
on a traditional basis. So
Yeah.
the next episode we will look at fixed deposits. What are the opportunities available in India? How where you can put those deposits? What you can do with them? And what are the tax implications? What is the risk involved? All of it we'll discuss.
Yeah, and strategies for investing large sums of money and avoiding risk. And I
Yes,
believe you also have recurring deposits in India, right? RDs.
there are a lot
Yeah.
different types of
Yeah. We'll
deposits.
be talking about
Recurring
them.
deposits are there,
Okay.
and then there are several tenors available, right from 7 days to n number of years.
Right.
So it depends on which tenor to choose. What should be your rationale for choosing a particular tenor? All those things we can talk about.
Okay. Thanks, Kumar. This was very educational, and I hope our viewers enjoyed this. So viewers, if you did like this, if you like this video, please do not hesitate to press a like out there, because your feedback helps us to improve the content of this channel. And we'll bring to you more and more information on various types of investment. And as our episodes go by, and once we have covered all the asset classes, then we'll be giving you dynamic information about market and all that. That's our plan going forward too. So if you are here for the first time, please do not hesitate to subscribe. We'll have more videos like this. And if you press the notify button, you'll get information as soon as we drop a video. So thanks for watching, and we'll catch up with you again. Bye for now.
Thanks.
Thanks, Kumar.